Federal income taxes are assessed on a progressive level. This means that the more income you earn, the higher your effective tax rate is. The first few hundred or $1,000 you make might not be taxed at all, while higher income earners may be taxed at a rate of 39.6% in federal income taxes alone, in addition to state taxes and payroll taxes. For purposes of this article, we will discuss only federal income tax, and not the various other types of payroll taxes, including Social Security and Medicare. There are four basic types of information that are relevant to the federal income taxation, and the bulk of your annual Form 1040, which is your federal income tax return. Those are your gross income, your above-the-line deductions, your below-the-line deductions, and your tax credits. Later, we'll discuss each of these in greater detail, though an overview of their role in determining your federal income tax bill is important at the outset. Your gross income is the amount that you earned. For employees, this is typically the amount reported under Form W-2 and/or 1099, in addition to whatever income the taxpayer may have received based on business income, dividends, interest, capital gains, royalties, etc. Your above-the-line deductions are deductions that can be taken off your gross income before your adjusted gross income, or AGI, is calculated. Because the amount of your AGI is important for many reasons, such as whether certain deductions or credits can be taken, above-the-line deductions are the best kinds of deductions. Your below-the-line deductions are deductions that can be taken from your adjusted gross income before determining your taxable income, and thus how much you actually have to pay in income tax. The amount of income that remains after all of your income tax deductions is your net income. The amount of income tax you actually pay is the applicable income tax rates multiplied by the amount of your net income. The rates vary based on your filing status, with single filers paying the highest rates and married filing jointly filers paying the lowest rates. By way of example, as of the 2016 tax year, in other words, returns filed in 2017, for a married filing jointly filer, up to $18,650 is taxed at a rate of only 10%, whereas, for example, above $470,700, it's taxed at 39.6%. And in between those two amounts, you have many other tax brackets, including 15%, 25%, 28, 33, and 35%. Tax credits are the best type of tax benefits for the taxpayer. The amount of the tax credit is reduced dollar for dollar from the amount that the taxpayer actually has to pay, after that amount has been calculated based on the applicable rates. We'll start our look at all of these concepts with income. Your taxable income includes all of the following. 1. All wages, salaries, and tips earned by the taxpayer. For full-time employees, these are reported to the employee and to the IRS by a Form W-2. All other types of compensation are reported in a Form 1099. 2. All taxable interest. Certain types of interest, such as those earned on municipal bonds, are tax exempt. These are typically reported by banks and brokerage firms to the taxpayer by a Form 1099 INT. Taxpayers who earned interest must also fill out a Schedule B with their tax information that details the interest earned. 3. All dividends earned by the taxpayer. Dividends generally fall into two categories: qualified and non-qualified. Determining whether a dividend is qualified is fairly complex. The basic rule is that to be a qualified dividend, the stockholder must have held the stock on which the dividend was issued for more than 60 days during the 121-day period that begins 60 days before the first date following the declaration of a dividend. Dividends are reported by companies and brokerage firms via a 1099 DIV. This form will also tell you how much of your dividend, if any, was qualified. Qualified dividends are taxed at the long-term capital gains rate, which is lower than the rate at which ordinary income is taxed. Non-qualified dividends, on the other hand, are taxed as ordinary income. Taxpayers who earn qualified dividends must also fill out Schedule Ds on their income tax returns. 4. All refunds, credits, and offsets of state taxes that the taxpayer received during the calendar year. 5. Alimony received by the taxpayer during the calendar year. 6. Income earned through the taxpayer's businesses during the calendar year. Losses suffered by the taxpayer while operating his or her businesses can be deducted from the taxpayer's gross income. Taxpayers who earned income from one or more businesses must file a Schedule C with his or her income tax return. 7. Any capital gain earned by the taxpayer during the relevant calendar year. A capital gain is a profit earned by the taxpayer, which is generally measured by the sale price minus whatever the taxpayer paid for the property in the first place, with certain adjustments. Capital gains can be long-term, if held for more than 1 year, or short-term, if held for 1 year or less. Long-term capital gains are taxed at a lower rate than ordinary income. In fact, they're taxed at the same rate as qualified dividends, while short-term capital gains are taxed as ordinary income. 8. Distributions from IRAs, annuities, or pension accounts, with certain exceptions, such as those from a Roth IRA. 9. Income from other miscellaneous sources, such as rentals from real estate owned by the taxpayer, royalties, distributions from trusts or other companies, of which the taxpayer is a beneficiary or owner, unemployment compensation, certain percentages of Social Security benefits, and other miscellaneous income. Note that virtually all income is taxed, including income from gambling winnings, lost property found by the taxpayer, and even income from illegal activities. Income that is not taxed is specifically exempted in the Internal Revenue Code. Some examples of exempted income include gifts received, inheritances, and many types of life insurance payouts. The addition of all taxable income leads to an initial determination of the taxpayer's total income. The next stage is to convert the taxpayer's total income to his or her adjusted gross income. To do this, the above-the-line deductions must be subtracted from the taxpayer's total income. The taxpayer's adjusted gross income, or AGI, is important because many deductions and tax credits are limited by the taxpayer's AGI. This is why above-the-line deductions are better than below-the-line deductions, as they decrease your AGI, thereby increasing eligibility for various other deductions and tax credits. Above-the-line deductions include expenses incurred by educators in the course of their teaching activities, contributions to qualifying health savings accounts, certain job-related moving expenses, the employer's half of payroll taxes paid by a self-employed taxpayer, contributions made to SEP IRA accounts, and certain similar retirement accounts for self-employed people, contributions made to certain other qualified retirement accounts, interest paid on student loans, and certain qualifying educational expenses, including tuition and fees, within certain limits. Once the above-the-line deductions are taken and subtracted from the taxpayer's total income, the number that results is the taxpayer's AGI, or adjusted gross income. Once the taxpayer's AGI is calculated, the taxpayer has two choices in taking further deductions. The taxpayer may take a standard deduction, which as of right now is $6,350 for a single filer or $12,700 for married couples filing jointly, although this increases every year. Any filing taxpayer is entitled to take the standard deduction, regardless of how many deductible expenses that person may actually have incurred during the year. Alternatively, the taxpayer may choose to itemize deductions by listing all of his or her below-the-line deductions on Schedule A. Obviously, the taxpayer should choose to itemize deductions only if the amount of itemized deductions exceeds the amount of the standard deduction. Taxpayers may vary their deduction strategies from year to year. Therefore, in most cases, it pays for the taxpayer to calculate the total available itemized deductions before making a determination as to whether to take the standard deduction or to itemize. Schedule A of the Form 1040 contains the below-the-line deductions that may be taken if the taxpayer chooses to itemize deductions. These include medical and dental expenses, but only to the extent that they exceed 7.5% of the taxpayer's AGI. State and local taxes. The taxpayer may choose to deduct either income tax or sales tax from the state. For most people, deducting state income tax provides the larger deduction. Real estate taxes. Interest paid on the mortgage loan of the taxpayer's primary residence. The value of charitable donations made by the taxpayer, specified amount tax deductions for each dependent claimed on your return, certain types of casualty or theft losses, and some unreimbursed job-related expenses, even if the taxpayer does not operate his or her own business. Note that Schedule A deductions are limited for those taxpayers whose AGI exceeds about $155,000. A sliding scale that is based on the taxpayer's AGI dictates the percentage of below-the-line deductions that may be deducted by the taxpayer in determining the taxpayer's taxable income. The taxpayer's taxable income, or net income, is calculated by subtracting all of these deductions from the taxpayer's AGI. The applicable amount of income tax is then calculated by applying the applicable tax rates. Once the total amount of income tax is calculated, it is then time to apply any applicable tax credits. Tax credits are the amounts that can be subtracted from the actual tax due. These are, of course, superior deductions, since they reduce the tax amount dollar for dollar, rather than merely decreasing the income upon which the tax would be calculated. Examples of tax credits include the Earned Income Tax Credit. This tax credit is available to taxpayers with relatively low earned income, though the amount of allowed income increases with increasing family sizes. While quite complex to figure out, the Earned Income Tax Credit can be quite a substantial tax credit for low-income wage earners. In fact, it is possible that the amount of the Earned Income Tax Credit will be more than the taxpayer's total tax bill, meaning that the taxpayer ends up paying a negative income tax. Next is the Child Tax Credit. As of now, the amount is $1,000 per dependent child. Next, credit for foreign taxes on the same income, or credit for certain educational expenses, and various other credits, including those for purchasing certain energy-saving materials or systems. Other adjustments to a taxpayer's bill are also possible, as the tax code is extremely complex in its entirety. Nevertheless, these four types of numbers are the fundamental building blocks upon which all individual income tax returns are based.